Did you know that passive fixed income ETFs only capture about 50% of the U.S. public bond market? But with JP Morgan Asset Management's active fixed income ETFs, we can help you capture 100% of the U.S. public bond market and explore twice as many opportunities. Visit jpmorgan.com/getactive to learn more. JP Morgan Asset Management is the brand name for the asset management business of JP Morgan Chase & Co. and its affiliates worldwide. This communication is issued by JP Morgan Distribution Services Incorporated, member of FINRA.
This holiday season is likely to be a roller coaster for logistics and manufacturing, but having the right staff in place can be easy when you choose Express Employment Professionals. They can handle everything to ensure you have the right size contract workforce. Go to expresspros.com. Solve your workforce challenges when you choose Express to support your hiring in a variety of roles, including two of our biggest areas, manufacturing and logistics. Visit expresspros.com today. That's expresspros.com.
Introducing the all-new Adobe Acrobat Studio, now with AI-powered PDF spaces. Do more with PDFs than you ever thought possible. Need AI to turn 100 pages of market research into 5 insights with a click? Do that with Acrobat. Need templates for a sales proposal that'll close that deal? Do that with Acrobat. Need an AI specialist to tailor the tone of your market report to sound real smart in real time? Do that with the all-new Adobe Acrobat Studio. Learn more at adobe.com/do-that-with-Acrobat.
Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, some big entertainment earnings are coming out this week. We'll break down what to expect from Disney and Paramount-Skydance. I'm Nathan Hager in Washington.
I'm Caroline Hepker in London, where we're looking ahead to Portugal's Web Summit as the country pivots to tech and AI.
I'm Doug Krisner, looking ahead to Singles Day in China.
That's all straight ahead on Bloomberg Daybreak Weekend. On Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and the Bloomberg Business app.
Good day to you. I'm Nathan Hager. We begin today's program with a look at some upcoming earnings reports in the entertainment sector. We get results this week from both Walt Disney and Paramount-Skydance. For more on what to expect from both these entertainment giants, we are joined by Bloomberg Intelligence analyst Geetha Ranganathan and Bloomberg Surveillance co-host Paul Sweeney, who spent a better part of his career covering the media. Great to have both of you with us on the weekend program. And let's start with Disney, obviously the biggest entertainment company in the world. Geetha, what are some of the key things we need to watch from the House of Mouse this time around?
Yeah, so I think, as usual, the big thing that we're watching for is the parks segment. This is the biggest segment for Disney, brings in about 60% of their profits. So obviously, any trends, any consumer trends are very, very important. One of the key things that, people have been concerned about for Disney for this year is the competition from the opening of Epic Universe in Florida, which happened in May. When they reported last, they actually showed really good results. They were able to hold their ground despite all of that competition. So I think we're expecting to see more of that, resilient demand going into the quarter. And then the other big thing that we're watching for is really the streaming business. So in August, ESPN launched its streaming platform for the very first time. We're going to look to see if Disney management team provides any numbers in terms of early adoption and just to see how that launch has been going.
Paul, you, of course, follow this company very closely as well. I mean, I got to admit, when it comes to Disney streaming, I sometimes forget about my Disney Plus subscription. I mean, am I part of the problem here? I mean, how do you see Disney navigating the very competitive streaming universe?
Yeah, I think Nathan, it all comes down, as it usually does in the media business, to content. And Disney has some of the absolute best content in the world, including live sports. So when you put that all together, it's just a question of how you deliver that content to people. And when I came up in the business, it was through the cable a bundle. It was through satellites like DirecTV. Now it's streaming. And so you just got to figure out how do you most efficiently get that content to your client when they want it, your customer, when they want it, where they want it, and charge a price that is profitable for you. And Disney has a great track record of doing that. Netflix paved the way in streaming and really showed kind of the world how this new media models can be. And now what we've seen from the legacy media companies over the last 10 years or so, as Geetha writes about with her research, is these legacy media companies are trying to catch up. They're trying to transition from a model where the cable TV bundle was really the way to go to now streaming. And Disney is really doing a good job. And I think the street believes that they can certainly be a really big player in the streaming business.
Yeah, Geetha, we've talked before about how Netflix has expanded its own streaming strategy with live events, getting into sports as well. And now with Disney introducing its own streaming sports platform with ESPN Plus, is it kind of like legacy media playing catch up again?
Yes, a little bit of that, but the way that they're kind of positioning ESPN, so Disney has to be really careful. They're kind of walking a tightrope here because remember, they have the leading brand when it comes to linear TV with ESPN. ESPN generates about $15 billion from the linear TV model year in and year out. We're talking about affiliate fees. They are the highest affiliate fee generator across the industry. They charge something like $10 per month per subscriber. So absolutely way above competitors who charge maybe, or other channels that are at like $1 or $1.50 per month. So obviously they have to be very careful to protect that legacy TV model. But at the same time, they want to be able to appeal to consumers who are outside the pay TV ecosystem. And there are a lot of consumers, by the way, outside the pay TV ecosystem. We're talking about 65 to 70 million households that do not take a pay TV or that do not subscribe to a pay TV bundle. And so it's really important to be able to provide access to sports content, and that's exactly what ESPN is going after. And we think that so far, they've done a really good job with that in terms of putting their content out there. You talk about catch up and are they a little bit late to the game? Yes, maybe in terms of Disney Plus, but again, with ESPN, they had to be really measured, really deliberate, make sure that they don't cannibalize, their linear TV business, which is really their cash cow.
And Paul, you mentioned the content slate that Disney has as well. We haven't even talked about their traditional business, what's coming in the box office. What are we expecting there?
It's interesting. As Geetha writes in her research, Disney is just in a phenomenal place from a content creation perspective. They've got obviously all the Disney product that has propelled the company for decades, but then they also have the Star Wars stuff and the Marvel stuff. And they just seem, if they see something good out there over the past 10 or 15 years, they went out and bought it. So they have the best content in the business, and they usually lead box office by a wide margin, although Warner Brothers is having a very good year this year. So again, Disney's at a spot. They bought the media assets, including the studio from Fox. So they have all of that content as well. So from a content perspective, nobody really can compete against them. So they're in a great spot there. And they monetize it better than anybody else, whether it's through the cable bundle, through the streaming service, bringing some of that content to their theme parks. That's kind of been the magic of Disney as a company and as a stock over the years, their ability to really monetize their content as well or better than anybody else out there.
We haven't even talked about the linear networks yet. They've got ABC as well, and I think this is going to be the quarter since the controversy surrounding Jimmy Kimmel, isn't it? Is this going to be a hindrance potentially, the traditional broadcast and cable networks, Geetha?
Yes, so, one thing that all media companies, this is not just Disney, have to contend with is cord cutting, is a lot of pressure with the linear TV networks. Of course, you had the Jimmy Kimmel, controversy. One thing that we're going to be looking for when they report is whether that Jimmy Kimmel suspension actually hurt their streaming numbers, because we did get reports that users were kind of canceling, their subscriptions. Again, I don't think it's going to be material, but this is something that all media companies have to contend with. What is the plan that they have for their networks? For Disney, ABC is a very important property because it shares a lot of the sports rights with ESPN. They do show a lot of Monday Night Football games. They have NBA games. There's a lot of college football. So ABC is still a very, very important property to them. Yes, they have a whole bunch of other cable TV networks. Think about the whole Disney suite, National Geographic, all of those channels that are definitely in secular decline. But so far, there are no plans, at least publicly, that Disney has said that they want to, necessarily separate that business or sell that business. So again, we're kind of contending here with a melting ice cube.
And Nathan, interesting on this subject, Laura Martin, a research analyst at Needham & Company, came out with a really provocative note about a month ago saying that Disney should just shut down the ABC network, make it go dark. Don't sell it, just shut it down. It's a declining business, and it's really the only business that is under federal regulation. And if you want to get out of the way of President Trump and maybe some heavy-handed regulation, just sell it or just shut it down, which I thought was an interesting topic.
Yeah, really interesting indeed. We're speaking with Paul Sweeney, host of Bloomberg Surveillance, and Geetha Ranganathan of Bloomberg Intelligence. Let's shift over to Paramount-Skydance, the first quarter that they're going to be reporting as Paramount-Skydance under the new ownership with David Ellison at the helm. A lot of job cuts, a lot of changes. Geetha, how could that play into the results?
Yeah, we really expect, the upcoming results to be a big reset in the whole Paramount-Skydance outlook. I mean, this will be the new management team's first big reveal of its financial plans. As you just mentioned, there's going to be a mix of major cost cuts to improve efficiency, and there'll probably be some major investments that they announce to support long-term growth, especially on the content side as well as on the tech side. We have to remember that this was a company that was undermanaged, underinvested in for years. So really looking forward to see what they have to say. But of course, the big looming question, other than results, is are they going to increase their bid for Warner Brothers Discovery? That is really the big question.
Absolutely. I wanted to get into that with you, Paul. Is Paramount-Skydance going to have to become Paramount-Skydance, Warner Brothers Discovery, or whatever other names they're going to have to put at the end of their title?
Yeah, it's interesting. They have an enterprise value of $30 billion, and at one point in time, that was a big media company. In today's world, it really is not, and I think, it's kind of, a lot of folks will call it, substandard in size. But you take a look at Warner Brothers Discovery, it is 3 times the size of Paramount at $90 billion of enterprise value. So it's really a big big pill to swallow there. So they're going to need some help. Now, it's nice when Larry Ellison is the CEO's father. That lends some support there, but they're going to need some partners probably if they want to pursue this here. So it'll be interesting to see how it plays. And as Geetha well knows, this is a company that is now officially in play. I mean, the CEO has said it, the board has said it. And so it's just a question of who and when, I think, and at what price.
Yeah, it would be fascinating to see. I mean, given the merger between Disney and Fox just a few years ago, if we see yet another major media entertainment merger like this, where could that position Paramount against Disney with competing giant content slates, Geetha?
Yeah, I think it puts them really within striking distance of Disney. It puts them within striking distance of even, I would say, Netflix, because they're going to have, a fantastic content budget. They're going to have some best in class, I would say, IP. So really, really puts them on the map, because right now, if you kind of look at Paramount, they have about 80 million streaming subscribers. You put that together, though, with HBO Max, which has about 130 million, you already get to 200 million, which is above what Disney has in terms of streaming subscriptions. So definitely makes them a major player, somebody that you have to take note of, and gives them a lot of firepower in terms of growing both the studio business as well as the streaming platforms.
Yeah, really busy entertainment earnings week on tap for us. Thanks to both of you for this. That's Paul Sweeney, co-host of Bloomberg Surveillance, and Geetha Ranganathan, media analyst for Bloomberg Intelligence. And coming up on Bloomberg Daybreak Weekend, we'll preview Portugal's Web Summit, one of the largest of its kind in Europe. I'm Nathan Hager, and this is Bloomberg.
Is passive investing costing you more than you think? Active ETFs aim to beat the benchmark, while passive ETFs just settle for them. Embrace an active strategy that helps you build stronger portfolios. Invest with a global leader in active fixed income ETFs with JP Morgan Asset Management. Visit jpmorgan.com/getactive to learn more. JP Morgan Asset Management is the brand name for the asset management business of JP Morgan Chase & Co. and its affiliates worldwide. This communication is issued by JP Morgan Distribution Services Incorporated, member of FINRA.
Support for the show comes from Public.com. You're thoughtful about where your money goes. You've got your core holdings, some recurring crypto buys, maybe even a few strategic option plays on the side. The point is, you're engaged with your investments, and Public gets that. That's why they built an investing platform for those who take it seriously. On Public, you can put together a multi-asset portfolio for the long haul. Stocks, bonds, options, crypto, it's all there. Plus an industry-leading 3.6% APY high-yield cash account. Switch to the platform built for those who take investing seriously. Go to public.com/market and earn an uncapped 1% bonus when you transfer your portfolio. That's public.com/market.
Paid for by Public Investing. All investing involves the risk of loss, including loss of principal. Brokerage services for U.S. listed registered securities, options, and bonds in a self-directed account are offered by Public Investing, Inc., member FINRA and SIPC. Crypto trading provided by Zero Hash. Complete disclosures available at public.com/disclosures.
Introducing the all-new Adobe Acrobat Studio, now with AI-powered PDF spaces. Do more with PDFs than you ever thought possible. Need AI to turn 100 pages of market research into 5 insights with a click? Do that with Acrobat. Need templates for a sales proposal that'll close that deal? Do that with Acrobat. Need an AI specialist to tailor the tone of your market report to sound real smart in real time? Do that with the all-new Adobe Acrobat Studio. Learn more at adobe.com/do-that-with-Acrobat.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Nathan Hager in Washington. Up later in our program, Singles Day in China is coming up. We'll get a preview. But first, Portugal. It's looking to accelerate the growth of its AI, technology, and startup industries. For more than a decade, the country's been luring top international business talent through its Golden Visa program. But now it's also playing host to billion-dollar investments from the likes of Microsoft and NVIDIA in new AI data centers. With the Web Summit in Lisbon taking place in the next few days, we want to get more from Bloomberg Daybreak Europe anchor Caroline Hepker in London.
Nathan, Portugal's Web Summit, which Bloomberg once dubbed the Davos for Geeks, is one of the largest tech summits in Europe. In the next few days, the forum in Lisbon will hold discussions on topics ranging from AI to cybersecurity to fintech, whilst playing host to speakers from Meta all the way to tennis legend Maria Sharapova. It comes as the country looks to consolidate its status as a tech haven and to court investment in its burgeoning AI and startup industries. Now, in the last few weeks, investors have grown increasingly concerned, though, about the prospect of stretched tech stock valuations and maybe even an AI bubble. NVIDIA's Jensen Huang spoke to Bloomberg's Ed Ludlow and tried to calm the market's nerves.
I don't believe we're in an AI bubble. And the reason for that is we're going through a natural transition from an old computing model based on general purpose computing to accelerated computing. We also know that AI has now become good enough because of reasoning capability, research capabilities, its ability to think. It's now generating tokens and now generating intelligence that's worth paying for, to the point where I'm paying lots of it.
That was NVIDIA's Jensen Huang speaking to Bloomberg's Ed Ludlow. Well, as tech CEOs then seek to reassure investors that AI spending shows no signs of abating, Portugal is positioning itself as one of the beneficiaries of Europe's AI build-out. How far, though, can the country's growing tech scene thrust its economy into the 21st century? Joining us now is Bloomberg's Portugal Bureau Chief, Sofia Horta y Costa. Sofia, good to speak to you. So should we start with the Web Summit, which is one of the largest of its kind in Europe? What do the main themes this year that they'll be talking about actually kind of tell us about Portugal's priorities?
It's kind of a greatest hits of the biggest talking points across AI and tech at the moment. So we do have AI and ethics, really exploring how to govern this increasingly important industry in Europe and how really to kind of align it with human values. We also have the future of work, climate tech,
growth in startups, you name it. And we do have the finance minister from Portugal attending and expected to speak. So that really shows you where the priorities lie for this new government that followed the elections earlier in May this year. That's really kind of throwing investment and subsidies at this industry, trying to position Portugal as one of the forefront economies to invest in the European Union.
Sophia, you've been writing about the town of Sines, which is on Portugal's dramatic Atlantic coast, that actually this could be a data centre, a tech hub, not just for Portugal, but maybe for Europe. Tell us about what's been happening there in terms of deals and breaking ground.
So this is really interesting because this is a very small town, about 15,000 residents. I went down there. It's about an hour and a half's drive from our Lisbon office. And what's happening there is investment from Chinese, US, European investors, and quite a lot of it. So my interest was, why are billions of dollars pouring into this really small Portuguese town? And one of them is what's set to be one of the biggest data center projects in the European Union. And it's 1.2 gigawatts. Now, Caroline, I have no idea what 1.2 gigawatts is. So just to put it in context, that's about as much as the entire metropolis of Lisbon consumes. So it's quite a lot of energy. Now, why does this matter? I mean, this is a big investment. It's a $10 billion data center. This is huge for Portugal. And Portugal is really trying to say, hey, we're not just tourism, even though it accounts for about a quarter of GDP and a lot of jobs. So incredibly important, obviously, still for the economy. But that was important to bring the economy out of the crisis, out of not just the financial crisis, but the sovereign debt crisis. But now, okay, let's invest in the future. This is where it's at. The government is making it easier for these companies to come here. I spoke to the Start Campus data center CEO, and he said, we were welcomed with open arms. And the Chinese battery maker, Calb, is the fourth largest battery maker in the world. So this is quite significant as well. That's a €2 billion investment. They just broke ground on their first battery factory outside of China. They picked Sines, this tiny, tiny town, as the gateway into the European Union. And this was really heralded by both sides of the political spectrum as a big step forward for Portugal in terms of the green energy transition.
Yeah, lots of visitors, but a population in Portugal only just about 10 million people. But the focus on data centres, raises the same question for Portugal as across Europe, which is that the AI boom is power hungry. There will be growing power demands. There's a worry about whether it's going to strain Portugal's energy system. I mean, we did see blackouts in Portugal earlier this year, and that was blamed on a number of factors, but one of them was, the green and clean energy system there. Is the infrastructure going to be able to cope?
So that's the big question. And there's been a lot of discussion at the government level, but also at the company level over who really should take the lead on investing in the grid infrastructure here. We actually had EDP, that's Portugal's biggest utility, today saying that it plans to allocate a significant amount of money into investing in the grid here in Portugal, but also in Spain, where they have a market. And I'll just tell you that number, 3.6 billion euros in electricity grids and infrastructure through 2028. That's a big number, Caroline. So the problem here, I guess the issue, I wouldn't call it a problem, is that Portugal uses renewable energy for about 70% of its energy consumption. So that's a pretty big proportion, and it still also imports a bit of energy, a lot of that from Spain. So whether to kind of reduce the reliance on the Spanish grid, that's one question. Whether to improve the infrastructure here and whether it makes sense for private companies to do that and share the load with the government. These are all still questions, and there's still a lot of looking into what happened around that blackout. But Portugal does like to blame its neighbours in Spain for that.
Indeed. In terms of startups, Portugal's also got an interesting scene there. Sword Health, this startup that uses AI for medical rehabilitation, for example, and that has raised quite a lot of money and is now more valuable than everything other than about 5 listed companies in Lisbon. Is that part of a kind of growing scene as well? If you're seeing data centres, you're seeing all of this interest. Is there also a bit of a growing startup scene in Portugal?
Yeah, there is. And, there has been an attempt for the past decade or so to really nurture startups in Portugal. But I think this one really grabbed my attention, Caroline, because it was valued at $3 billion in a financing round last year. And this year in June, it was valued at $4 billion. And as you said, this is pretty significant for Portugal. It's one of the most valuable private companies for sure, and one of the most valuable companies, full stop, in Portugal. And it's also backed by founders funds, so very high profile investors looking at this company. And what it does is obviously quite interesting. It's looking at pain management solutions and physical rehabilitation using AI, obviously a buzzword for investors at the moment. But, the fact that you can found these companies in Portugal, you can also stay here, not necessarily have to go all the way to Silicon Valley to scale, suggests that the country is taking these things more seriously, is understanding that these companies need more of an infrastructure around them. And the government actually just recently said it would cut taxes for companies, which would be a big help as well.
Okay, that's interesting. In terms of what the government is hoping for and what the public in Portugal make of all of this, Portugal's still got a GDP per capita that is amongst the lowest in Western Europe. So there must surely be a desire for the economy to do well. But what is the government's political ambition? What's the response from the public?
So there's always a tension between the foreign money that's coming into Portugal, which has obviously been hugely important for the economy, not just these kind of investments into tech, but also from overseas residents coming to live here. Portugal has seen a big rise in American, Chinese, Russian citizens coming to live here. There's a tension between that and what it can do for the country and the country's economy. But actually, what that means for the locals who have always been here and are seeing the price of real estate go up beyond affordable levels. The housing affordability in Portugal has actually seen the worst decline in the European Union in the past decade. So it's a huge tension point for the Portuguese public here. And actually, when I went down to Sines and spoke to locals there, they said, it's all good and we respect what the government's trying to do in bringing Chinese and American investment here. But our buildings are, crumbling. We only have one healthcare center. The hospital's far away. The roads are cracking. Where is the investment actually in locals and in what we care about and in creating jobs for people who really still struggle to pay the rent and the rising energy bills and send their children to school. So there's always that tension between local interests and what the government is doing at the macro level, which is attract as much foreign investment as it can.
Very interesting. Sophia, thank you so much for spending some time with us. That is Bloomberg's Portugal Bureau Chief Sophia Horta e Costa. Of course, this comes ahead of the Web Summit, which takes place in Portugal in the next few days. And we'll continue our full coverage and analysis of Europe's AI build-out here on Bloomberg Radio. I'm Caroline Hepker in London. You can catch us every weekday morning for Bloomberg Daybreak Europe beginning at 6 a.m. in London. That's 1 a.m. on Wall Street. Nathan.
Thanks, Caroline. And coming up on Bloomberg Daybreak Weekend, Singles Day in China is approaching. We'll check in on what's become the largest shopping day in the world. I'm Nathan Hager, and this is Bloomberg.
Support for the show comes from Public.com. You're thoughtful about where your money goes. You've got your core holdings, some recurring crypto buys, maybe even a few strategic option plays on the side. The point is, you're engaged with your investments, and Public gets that. That's why they built an investing platform for those who take it seriously. On Public, you can put together a multi-asset portfolio for the long haul. Stocks, bonds, options, crypto, it's all there. Plus an industry-leading 3.6% APY high-yield cash account. Switch to the platform built for those who take investing seriously. Go to public.com/market and earn an uncapped 1% bonus when you transfer your portfolio. That's public.com/market.
Paid for by Public Investing. All investing involves the risk of loss, including loss of principal. Brokerage services for U.S. listed registered securities, options, and bonds in a self-directed account are offered by Public Investing, Inc., member FINRA and SIPC. Crypto trading provided by Zero Hash. Complete disclosures available at public.com/disclosures.
Introducing the all-new Adobe Acrobat Studio, now with AI-powered PDF spaces. Do more with PDFs than you ever thought possible. Need AI to turn 100 pages of market research into 5 insights with a click? Do that with Acrobat. Need templates for a sales proposal that'll close that deal? Do that with Acrobat. Need an AI specialist to tailor the tone of your market report to sound real smart in real time? Do that with the all-new Adobe Acrobat Studio. Learn more at adobe.com/do-that-with-Acrobat. The Chase Ink Business Premier Card is made for business owners who make things happen. Designed for high spend and limitless cashback, Ink Business Premier is a pay-in-full card with built-in flexibility. Get the buying power you need to make large purchases, cover unexpected expenses, and help your business grow. Earn a total of 2.5% cash back on every purchase of $5,000 or more. Plus, earn unlimited 2% cash back on every other purchase, giving you unlimited earn potential to invest cash back into your business, from innovation and technology to everyday expenses. Ink Business Premier is the only business credit card with 2.5% cash back on every purchase of $5,000 or more, and is part of a suite of credit cards from Chase for Business, designed to meet your needs every step along the way. Learn more at chase.com/business card. Chase for Business. Make more of what's yours. Account subject to credit approval. Restrictions and limitations apply. Cards are issued by JP Morgan Chase Bank, N.A., member FDIC.
I'm Nathan Hager in Washington with your global look ahead at the top stories for investors in the coming week. Now we want to head to China, where Singles' Day will be celebrated in the coming week. It's the unofficial holiday that's become the largest shopping day in the world, and it's spreading across Southeast Asia. Let's get to the host of the Daybreak Asia podcast, Doug Krisner, for a preview.
Nathan, retailers in China are not taking any chances. This year, many have stretched their sales to as long as 5 weeks. Now, we know the Chinese economy has been struggling. Weak domestic demand has become, call it a characteristic. And so, e-commerce giants like Alibaba, JD.com are working to entice shoppers. The question is whether they'll succeed. For a closer look, I'm joined by Bloomberg analyst Catherine Lim. She covers the retail and e-commerce industries in Asia from our bureau in Singapore. Catherine, thank you so much for making time to chat with me. Can we talk about the big picture first? Talk to me about expectations and the extent to which these big retail names are concerned, perhaps, about underperforming.
We had a very weak third quarter in China, and that's really pushing retailers to, bang the buck and try to get more out of Singles' Day and in fourth quarter. And the reality is, as I speak to retailers over the last 2 weeks itself, Singles' Day is off to a fairly weak start. We're halfway through the shopping festival right now. I do see more promotions coming up, and keeping the fingers crossed that that's enough to really try and push things ahead.
So, Catherine, I'm wondering about the role of the government in trying to make Singles' Day a success. What steps, if any, has Beijing taken?
Well, we've seen the offer of, vouchers, perks. They are also supporting e-commerce platforms and retailers to try and come up with better service levels. But at the end of the day, it's really the confidence of the consumers right now, particularly if property prices, asset value still stays very low, income's outlook still stay uncertain, it's going to be hard for the consumers to want to spend more in, an environment of uncertainties. I'm
wondering about U.S. brands like Apple and Nike. What are the expectations for these brands?
Now, what is interesting is that, for these two brands, they were off to a very weak start since the beginning of the year, and we've actually start to see things coming up better for them different fundamental reasons, off a lower base, but they are creeping up. And I'll take Nike, for instance. On the first day of Alibaba's sale, they were off to a very weak start. They did not lead the sportswear sales ranking as they did before in the last 2 years. And, 2 weeks down the road, they've actually creeped up to being the third. Nowhere near the first, but, still a good, improvement. And again, I'm hoping to actually see more over the next 2 weeks.
So do you think it's more likely that Chinese consumers will favor the local brands this year, perhaps more so than they have in the past?
I don't think it's going to be that distinct this year. It's more about, the value proposition that's on the table for the consumers. We are at the somewhat balanced point between nationalism, being very nationalistic about local brands itself and foreign brands. At the end of the day, it is what is on the table at a good price, for the consumers, and they will be willing to take that if it comes true.
Not a day goes by when we're not discussing artificial intelligence. And I'm curious about the way in which companies like JD and Baba are using AI to drive sales this year.
Well, there's lots of, AI shopping assistance, lots of marketing push, just based on what you are browsing. It's a lot more back end rather than, what we see as consumers itself. But clearly, they know what we are looking at and they are pushing these items, repeatedly to the face of the consumers to try and get the conversion rates to actually go up. So, this is definitely a good period during Singles Day to test out some of these algorithms as well as these programs, because that's where they're going to actually try and improvise on that for 2026.
So as long as we're talking about technology, how has the smartphone business been performing on the mainland?
Well, definitely we are still seeing some form of subsidies coming through from the government, so that's actually helping. iPhone 17 model, so far the platforms, whether it's JD.com, Alibaba's Tmall, they've been actually pushing for more sales of it. And I'll actually like to throw in that Meituan, which has actually ventured into speedy delivery or quick commerce for that matter. They are also now being able to actually deliver new iPhones to you, within an hour.
So we know Singles Day started in China, and since then it's spread to many parts of Southeast Asia. So I'm curious, away from the mainland, when you look at other jurisdictions, I know you're in Singapore. I'm also thinking about Hong Kong, even Taiwan. Are there other jurisdictions that are expected to perform, let's say, better than the mainland?
I think if we actually look firstly at Singles Day is no longer about China, and I think you're right on that we are also seeing AliExpress, Taobao Global, JD.com Global also launching promotions and campaigns for this Singles Day outside of China. So are they doing better? I think, yes, for certain jurisdictions like Singapore, for Southeast Asia, and it's really because we're off from a very low base and we're starting to actually see more of those value propositions coming through from made in China products. And, they are actually very decent for the price that you're actually paying for them.
So, Catherine, what about experiences, whether it's entertainment or even visiting a restaurant? Are these industries expected to do well?
That has actually taken off during the long National Day holiday. And, when you talk about restaurants, the consumption itself, let's not forget that, there is now the counter coming in from takeaways, food deliveries. And again, I'll go back to what I've just mentioned about the convenience, the ease of it. We've actually seen the latest catering or restaurant services sales continue to actually slow down. There may be a bit of uptick in October. The overall scheme of things, I think more people are actually, doing food deliveries rather than going to the restaurants.
Catherine, we'll leave it there. Thank you so very much. Bloomberg's Catherine Lim, our senior analyst covering both retail and e-commerce across the APAC from our bureau in Singapore. We go to Hong Kong next, where the Global Financial Leaders Investment Summit took place over the last week. That's where we caught up with Goldman Sachs CEO David Solomon. He spoke with Bloomberg TV host Yvonne Mann and David Ingles. The conversation started with a question about the U.S.-China trade truce.
I think at the moment, a de-escalation is a good thing, but there's obviously a lot of work to do. to really arrive at a real stable deal that can endure, over a period of time. I'm encouraged by the prospect of a potential visit from the U.S. president that was telegraphed in the fall. But for the moment, I did not think the escalation on either side was constructive. And so, I much prefer a de-escalation. And I think both sides really had a purpose in that meeting to talk constructively, to have a more de-escalated environment. And that allows now for constructive conversations as they move forward.
1 year truce, though, between the two. Is that a good or bad thing? I mean, what does it do in terms of business sentiment when there's a 12-month time frame now we're talking about?
It's better than an escalation at unreasonable levels, which is kind of where we were, over the most recent time. Trade negotiations are complicated, and there are a lot of issues on the table. They need thoughtful responses and responses that can be durable. Yes, there's some uncertainty because it's a 1 year delay in all of this, but it's also a realistic period of time to try to get the right kind of deal done so both economies can move forward in a constructive way. And look, these are the two most important economies in the world. Right. I think it's very important that, we arrive in a better place where we can both participate constructively with each other in the global growth of the world.
I mean, speaking of, let me borrow your phrase, participate, there's been a resurgence in equity capital market raising here in Hong Kong. A lot of the Chinese companies, tech or otherwise, are raising capital for the future. I want to get your sense, as someone who sits in New York, you travel, of course, all around the world. Is there a lot of appetite now from U.S.-based investors to participate by giving that capital to Chinese companies right now in order to realize their ambitions? Sure.
There's more appetite for it than there was 12 months ago. I remember actually last November sitting in a dinner in the United States with a group of U.S. investors. And this topic came up, and there were a couple of investors that basically said, we all should be looking to China. And the reason that had evolved that way is if you look last fall, the prices had gotten so cheap, the capital flows had moved so in the other direction that you just knew that things would come more into balance and there'd be a recycling. And we've seen that recycling. You've seen a big move in prices year over year. You've seen more foreign capital come in and start to participate. That's a fundamentally different question about the big capital allocators really fundamentally shifting their allocations up to be higher again. So foreign direct investment in China has come down. And I think one of the big questions is until we understand kind of the trade and the geopolitical landscape, it's harder to see significant shifts back to higher levels of foreign direct investment and more capital allocation. But for the moment, those flows are making for a better IPO market here and more opportunities here.
How do you look at that? I mean, the whole competition has kind of changed into the dynamics, right? You have so many of these Chinese banks now that are doing some of these deals with Chinese companies when it comes to going public. How does Goldman Sachs compete?
Well, Goldman Sachs competes just fine, thank you very much. When it comes to taking companies public on a global stage, Goldman Sachs is a leading position. We've had a leading position for 50 years, and there's always competition in the business, and we'll continue to compete. So we welcome competition, but we have a pretty active footprint out here, as you well know. We have a pretty active footprint around the world, and look, one of the big advantages. I just had breakfast with a company here. That it's actually a Chinese company, but the CEO, the founder, was here. And why does he value Goldman Sachs? He values Goldman Sachs because we have access to people, information, capital markets all over the world, not just in a narrow portion of the world. And so it's a competitive business. It always will be, but I'm comfortable that we have the resources and the position to compete effectively.
Right. And, I've been reading up, of course, and I understand your history. You guys have been doing business in China a very long time. You guys took the big banks public back 20 plus years ago. So, I mean, you're headed there, my understanding, after here. You're going to China, of course, to speak with regulators, what have you. What's your long-term vision for the franchise in Greater China? What do you want? What do you want your franchise to become longer term?
I think you have to look at Goldman Sachs and just think strategically that as a global firm, that when you think about our businesses, what are our two big businesses? Global banking and markets, the investment banking and trading business, and asset and wealth management. And so if you think about how we think strategically about the firm, what advantages does the firm have? Besides the fact that we have at-scale businesses, we're very good at those activities, we're leaders in those activities, and we have a right to compete and win, in those activities.
That was David Solomon, CEO of Goldman Sachs, speaking with Bloomberg TV host Yvonne Mann and David Ingles at the Global Financial Leaders Investment Summit in Hong Kong. I'm Doug Krisner. You can catch us weekdays for the Daybreak Asia podcast. It's available wherever you get your podcast. Nathan?
Thanks, Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Nathan Hager. Stay with us. Top stories and global business headlines are coming up right now.
Hey, Ryan Reynolds here from Mint Mobile. Now, I don't know if you've heard, but Mint's premium wireless is $15 a month. But I'd like to offer one other perk. We have no stores. That means no small talk. Crazy weather we're having. No, it's not. It's just weather. It is an introvert's dream. Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan. $15 per month equivalent required. New customer offer first 3 months only. Then full price plan options available. Taxes and fees extra. See mintmobile.com.
Greetings from my bath, festive friends. The holidays are overwhelming, but I'm tackling this season with PayPal and making the most of my money. Getting 5% cash back when I pay in 4. No fees, no interest. I used it to get this portable spa with jets. Now the bubbles can cling to my sculpted but pruny body. Make the most of your money this holiday with PayPal. Save the offer in the app.
Ends 12/31. See paypal.com/promo terms. Points can be redeemed for cash and more. Pay in full subject to terms and approval. PayPal Inc. and MLS 910457.
You know what a girl's best friend is? Not diamonds, her lawyers.
From executive producer Ryan Murphy comes a fiery new legal drama
It's our own boutique. Women representing women.
you can't afford to miss.
Make it rain.
Showtime, ladies.
Stand up straight and breeze into that room like a storm no one saw coming.
Hulu original series, All's Fair, now streaming on Hulu and Hulu on Disney Plus. For bundle subscribers, terms apply.